Hey everybody, Ryan Bolton here. I am a mortgage nerd with Patriot Home Mortgage. So you filled out your loan application, and we now have enough information that by federal law, we have to send out certain loan disclosures. One of the big disclosures is called a loan estimate, or LE. This estimate is going to break down what the costs are to get the loan. But we're very early in the stages with the initial disclosure, and we only have a certain time frame to get that out. So we generally create templates of certain fees and usually go on the high side of those fees because we cannot charge more than the invoice, but we also cannot disclose a number and then have that number go up. So a lot of times the initial disclosures are designed to be worst case. There's a little bit of padding that's built in until we lock your interest rate, get the insurance, the appraisal, title work, all this stuff back before we actually lock in those fees. So the initial disclosures are designed to be worst case and give you some other information about the process and what to look for as you do your loan. Also in the loan disclosure, there'll be some borrower authorization so we can verify your employment. There'll be some authorizations with the IRS to verify tax returns and things like that. So I'm going to walk you through what the disclosures are, what they mean and what kind of their purpose is, and how our system works to electronically sign these disclosures. Then once we lock your loan, lock your interest rate, or we get other information, we will update that loan estimate through the process. Then, 3 days before you can sign the actual loan documents and actually get the property or refinance, we are going to send you an updated loan estimate known as a closing disclosure, or CD. You'll hear that term kind of floating around that everybody's looking for a CD. It's not a compact disc, it's a closing disclosure. The nice thing is that closing disclosure will do a comparison to the last loan estimate you were issued, and certain fees cannot go up. Some fees can only go up by 10%, and there are some fees that can change no matter what they need to. Let's say there's an HOA fee we didn't know about, or something like that that isn't necessarily a loan fee. We can add those back in. But we really try to be as accurate as we can with the information that we have with the initial loan estimates, because we want to give you an idea of what you need to bring to closing, what your payment's going to look like. So we try to get them as accurate as possible. And if anything, a little on the high side. We try to overestimate and make sure the numbers get better as we go along. But again, 3 days before you sign the actual loan, you'll get a final closing disclosure, which will do a side by side comparison to what you were quoted at the beginning to what you're actually getting at the table, at the closing table. And you have 3 days to review it before you actually sign your loan documents. So I thought this video would be helpful to walk you through the email that you're going to get, what to fill out, where to put the information, any of that type of stuff. And hopefully you'll find this information useful. But if you have any questions, comments, or concern, please reach out to me and we can get your disclosures out correctly or make any corrections that need to happen. But this is the initial set of loan disclosures, and let's walk through each one of them. Okay, I've created a test file that I've named Ryan Test. What you'll first see is some sort of email that looks like this. It says a loan application has been submitted. Thank you. We'll reach out to you as soon as we have that application reviewed. So you'll either get that if you fill it out online or if you do it over the phone with me. But the next email you should get is from our compliance team. It can be a different person depending on who actually does the disclosures. There's a few people on our team there, but it'll have your name. It'll say Patriot Home Mortgage, initial disclosures issued and require your signature. So you'll get this little email and there'll be a little button to click right here. It says click here to view the website. When you click on this, it's going to open up a text box to send you a code for your cell phone to confirm it's really you that's opened this email. So once you put that PIN number in, the next thing it'll do is set up your username, which will usually be some form of your name that's just whatever's available in our system. Then you create some sort of password. So let's see if we can use everyone's favorite password. Password one exclamation mark. Let's see if this works. I'm not even sure if it will. Oops. Let's see if this even works. I did password one exclamation mark. This is just a dummy file, so it really shouldn't matter. Oh, it looks like it's going to work. Or maybe, let's see. Okay, so now it's got the tasks that are in here. It shows you a rough breakdown of kind of the loan that we're working on. It does show that you've e-consented when you first did the application. And if you didn't, then we have to send you another link to e-confirm. So we'll do another video on how that works. But in most cases, it'll go right to this screen. It'll have a home loan toolkit that you can look at here. It'll give you all kinds of tips, review documents, all those types of things. But the main thing we want to do in this video right here is just go to the e-sign documents tab. So we're going to hit this little button that says sign. This is going to open up a DocuSign, and you'll have a little next button here. If you view DocuSign, this will look really familiar. If not, you can go ahead and OK on cookies. But right here, you just hit next. It's going to take you to this start button that will have you start signing these disclosures. So let's just go through each one of this. This first one is to verify that the tax forms you give us match what the IRS has. So the W-2s, make sure they've been filed on your tax returns, things like that. So we use a third-party system to be able to verify through the IRS that you have filed your tax return. So you'll go down here to this little tab and hit required signature. Now, if you have a digital signature, you can upload it. I don't think many people do, but it's starting to get more popular. You can just select a style if you think that looks fine. Or if you have a pen, you can actually just kind of write it if you want. So like this, if you want. I would say most people just select a font, and that's good enough for these digital signatures. So you adopt and sign. So anytime you click these little signatures, it's going to put that time stamp on there. So then we'll go down here to the next one. So this next form is actually where you sign is a credit authorization. So this just explains to them any concern we will be pulling the credit report. So we'll go ahead and click that. It does kind of scroll down really quickly, so you just have to scroll back up to view it. And you can go through and sign everything and then kind of go back through it. So it's whichever way you want to do it. This next disclosure is the Utah Notice of Loan Sale, Assignment, or Servicing. So this just talks about many loans in the state of Utah, many loans around the country get closed by an originator or a broker or some sort of lender, then it gets pooled up with other loans and the servicing gets sold. Now, sometimes we own the servicer, so sometimes we still have the loan. It's just changing departments. Other times it's selling off the entire block of loans, depending on the type of loan that it is. Like, for instance, Utah Housing does a lot of their own servicing. So we do the loan in our name, but then they take over the servicing, the day-to-day collecting your payment escrow accounts. So some loans, that's just naturally how it goes. Like VA loans, USDA loans, certain loans get sold to servicers that handle that type of loan. Other times it's just moving within our own company. It's just going from Patriot to Bellum or something like that. So, but this is just a disclosure that Utah requires that we have to give you notice whenever a loan does transfer servicing. And they're not changing anything about the loan. They're just buying the terms of that existing loan. So we'll click the box there. Scroll back up right here. You have a right to choose your own insurance provider. So you can choose whoever you want. Now, I have a couple referral partners that I use. So I always try to recommend people that I know that do good service. And I just have to deal with insurance on every single file. So I kind of get an idea what's a good rate on a particular property. So I usually will recommend an insurance company, but you can use whoever you want. You have the right to choose any insurance that you want to use. And a good recommendation is to check with the insurance company that's doing your home loan, or excuse me, doing your auto insurance. So, if you're doing your auto insurance, you want to check on them for your homeowner's insurance. This next one's important. It just is an intent to proceed, that you're acknowledging that you do want to move forward. As you go through these disclosures, you can decide if you decide you don't want to. But the idea is that we've sent out the disclosures, the numbers are close. You do want to take the next steps of actually doing the loan. Doesn't force you to do a loan, just says you intend to move forward. So that's what's there. Acknowledgement of intent to proceed. The next one here talks about the insurance coverages. So it does show what is required. So you'll see these little numbers here. And I will tell you this, the homeowner's insurance that the lender requires is not typically what you'll actually want to get. Just like on your car insurance. If you don't have car insurance, they're going to put forced place insurance in there. And generally, it's just barely enough to cover loans. It doesn't really have all the protections you want. So this is just saying what the requirements are of the home insurance as a minimum. But I would tell you almost every policy exceeds the minimum that is required, but just at least tells you what we do require. And then you do need to add this little thing right here, this mortgagee clause, to the insurance, but we can help you with that. All we need is the agent's name and phone number, and we can get what we need from them. But this just says that this is the requirements. So we'll sign that one. Next one right here is arm's length transaction. So this is talking about that we need to make sure that there's no relationship that's outside the transaction, either personal or business. We just have to make sure that this is an arm's length transaction, that it's not something happening where you know the sellers. And you can, we just have to have different loans, different guidelines if there is a relationship there. But you are basically stating that this has no prior relationship outside of the transaction with the seller or the buyer. All right, so we'll go down here. Right here is undisclosed debt. So this is something that's really important. Sometimes people won't tell us about other debts that they have. And the most common, I would say, is child support, separate maintenance, or alimony. We usually end up finding that out down the road if we see a maiden name switch or addresses switched, or there's some other name that pops up on a previous property profile. So we usually will find out that there is some sort of divorce situation, and that usually opens up the door of some sort of decree if somebody owes or is being paid child support. Now, we don't have to use the child support as income. Sometimes we can't. So it's not something you have to necessarily disclose if you're getting it, but if you're having to pay it, we have to add that to the debt ratio. We've also seen times where people have private notes. Maybe they've got a private car loan with somebody else that doesn't report to credit, or they have some seller financing on another property. So it's very important that there is other debts out there to talk with your loan officer and explain what those other debts could be. So this is acknowledging that you don't know of any other debts that are out there other than what's on the credit report. Next, right here is the RESPA Housing Counseling Organization list. So we're going to give you a list of all the HUD approved, RESPA compliant home ownership counseling groups. So if you have any questions or want to have a third party look at anything or have any disputes and just kind of want to have anything, there's a lot of home buyer education courses they offer as well. In fact, some of the down payment assistance programs require that you take a home buyer's education course. So we're going to give you a list of the ones that are available within your area. So that's what this is acknowledging. And it even has the website for the CFPB, which is one of our regulators. So I'll go back up here. Like I said, it's kind of zips down, gives you some of the definitions of what those counseling groups are. So, and also the private policy disclosure. Let's see if I can make the screen just a little bit. There we go. Okay, next one is notice to the home applicant credit score information disclosure. So this is going to give you your 3 credit scores. So we actually have to show you what your scores were and what the key factors were. Obviously, in this case, I don't have an actual credit report in here because I have a test case, but this would actually show you the 3 credit bureaus that we pulled of the 3 borrowers, whoever's on the file, what those credit scores were. And the main reason why we want to do this is there's been people that will tell us, hey, my credit score is really bad. So, and we pull it and it's not as bad as they think. People in the past were basically giving people higher rates because they thought their credit was worse than it really was. So that's kind of a sneaky thing to do. And basically regulation said, hey, you need to actually disclose to them what their credit score was. Now, we don't have to give you a full copy of the report. We can give you a consumer copy. We can kind of show you what's on your credit file. But we at least have to show you what your scores are that determine the interest rates that you're going to get. Now, when we pull the 3 credit bureaus, which is Equifax, TransUnion, and Experian, we take whatever credit score is in the middle of those 3. So kind of that becomes your middle score. Then we take the lower of any borrower that's on the file. So we have a husband and wife, and the husband's middle score is lower than the wife's. Then the wife's score is what we actually take for the file. So that's the actual score for the credit profile. So it's all 3 bureaus take the middle one, then the lower of the 2 middle ones. Or if there's 3 borrowers or 4 borrowers, it's whichever one is the lowest on there. So a lot of times I'll look at that and think, okay, if we don't really need that person's income or credit, or they don't need to be on the loan and they have the lowest credit score, a lot of times we'll look at dropping them off or not having them on there, but keeping them on title. I mean, there's ways to make that work. But a lot of times, if you don't need that person on there just kind of dragging down the credit profile, you might be better off to remove them off the credit. But it's whatever's the lower one. Now, I've had people ask the question, well, can we use my income but her credit? No, it's the lower of the 2 middle credit scores. And it's not an average. So we don't add them all together and divide it by 3. It's whatever score is in the middle and then the lower of 2. All right, let's keep going. It's kind of fun. Oh, I got to hit the required signature. Let's scroll back up here. Okay, this next one is borrower's authorization, certification and authorization. Borrower's certification and authorization. It's saying that you are who you say you are. You're giving us the right information, and then you're allowing us to release information. A lot of times we use this for verifications of employment. So they'll want something signed or something that is acknowledged. More and more want you to specifically request it. These forms are starting to get less and less acceptable by third parties, just for all the privacy policies and all that have just gone up so much for good reason that sometimes we can't use this form. But a lot of times this is a form we can send off to the hazard insurance company to show that we're working together and verify that you really are working with us on doing a mortgage loan. And we use this for whatever we can to verify. Now, if they reject the form or just don't want this, that's when we have to get you involved and say, hey, can you call your HR department and let them know that we were trying to do a loan and just verify your start dates and things like that. But a lot of times we still get this form signed because it does help us to get as much verifications done without having to get you involved or have you walk through every single verification. All right. Next one is equal credit opportunity notice. So this is a notice that says you have the right to not be discriminated against on protected classes like race, color, religion, national stat or national origin, sex, marital status, age. Age is definitely one of those protected classes. So that's why you can do a 30-year fixed if you're 70. You just have to be of age to sign the contract, so at least 18. But after that, there can't be any discrimination based on age. So this is a notice to you. Now, if you feel like you have been discriminated against, you can write to the Federal Trade Commission or report to a bunch of different regulators out there. But this is saying that this type of loan is covered under the Equal Credit Opportunity Act. Next one is don't commit loan fraud. So mortgage fraud is investigated by the FBI. Here's all the statutes that they mainly look at about bank fraud, wire fraud, giving a false social security number. You can see the list here. And it can be up to 30 years in prison, up to $1 million fine. So they've really kicked up mortgage fraud fines. So this is saying don't commit loan fraud. If you feel like loan fraud has happened, you can turn it in. And if you're trying to commit loan fraud, there's a lot of ways we try to catch it, but just know that mortgage fraud is investigated by the FBI. All right, next one, Patriot Act. So this one again is saying that we have to verify who is on the loan. We also have to report any money laundering activities that we find. We also have to report what type of loan that this is doing, whether it's a purchase, cash out, refi, that type of thing. Now, we don't have to report there's certain things we don't have to report, but it is something whenever money is going through the banking system, there are certain protections that we have to do under the Patriot Act to make sure it's not funding money laundering activities. And unfortunately, real estate's a great way to clean the money. They're able to buy a home with cash, then sell that home, and all of a sudden now they've got this clean money through the system. So there is a lot of mortgage fraud that goes through banking, obviously, and a lot that goes through the buying houses. So the Patriot Act does fall into mortgage lending. Next one is Fair Credit Reporting Act. So this talks about how we report to the credit bureaus, and you'll see another disclosure on here, but we do report if you miss or you're more than 30 days late when you do the mortgage loan. So it is something where we still report to credit. So because of that, we have to acknowledge the Fair Credit Reporting Act. All right. Next one is consent to use the tax returns. This is kind of a new one that people would say, well, I get you the tax return, but I didn't give you consent to use it. So, of course, all right, we got to acknowledge that. We have to send out a disclosure that says, hey, you're giving us the tax returns. You're giving us authorization to use that as verification of income to know that that is part of your debt servicing and your ability to pay back the loan. So now we actually have to have a consent that says now that just because you've handed us the returns doesn't mean you actually let us use them. This is acknowledging that you do allow us to use the tax returns for income. All right, I think we're getting to the big one here. Okay, the next one, this is the big one. This is the one we talked about at the beginning of the video. This is the loan estimate. So we're going to take a little time on this particular form. The loan estimate is a standardized form with every mortgage company. So it's not going to matter if you go to ABC Mortgage Company down the road or use us at Patriot. We all have to use this form. It's all standardized. Now, the name we call a fee can be a little bit different, but almost all of them are going to be categorized in certain boxes. And those boxes trigger the ability not to raise that fee in that specific box. So we can't just not disclose a fee and then try to add it on later. So what you'll see, and like we talked about earlier, is you'll want to have some of those fees padded a little bit until you know exactly what it is. Like a common one's the credit report. When we first pull the credit, it's about $40 for the very first credit report. But if we have to change the name or add something, or we're doing a rescore, or we have to do something where we have to pull it again, then we have to charge another fee. Or sometimes we have to update the credit. It's usually a month behind on some of the trade lines, especially mortgage payment history or stuff like that. We have to update the trade line with what's called a credit supplement. That has some fees associated with it. So a lot of times we're going to pad that fee until we know exactly what supplements, repulls, adding people on, taking people off, whatever it needs to happen. So we always kind of pad that disclosure a little bit. And then as we get down to the end, we can only charge what's actually on the invoice. So we can't disclose, say, $120, have it only be 40 and keep the difference. So we can only charge what's actually on the invoice. But if we disclose 40 and it goes to 120, we have to eat the difference. So we're better off to at least over disclose a little bit and tighten up the number as we get closer to closing. That's one of the common ones is appraisals, credit reports. There's like foundation certification, sending the appraiser back out for re-inspections. There's all kinds of stuff that we try to make sure we pad that number a little bit until we know what the official number is. There's now other fees like homeowners insurance or recording fees. Those allow more variance. They allow us to be able to kind of guess on that and have a little room to go up. But generally, we try to make sure all the numbers are going down. So we have enough experience to be able to say, okay, this is what we typically see for this type of home, this type of loan amount. Here's what we're going to put in there. And a lot of times before we send out the disclosures, we will talk to the title company, at least confirm their fees, but something could change there as well. Maybe the loan amount changes. Maybe they find out there's HOA fees. Maybe they find out that they have to do a survey. I mean, stuff pops up. So we do have a little bit of room, but generally we're going to try to make sure this initial disclosure is designed to be worst case. So let's go through page 1 here real quick. So I just put a loan amount of $450, interest rate of 6%, gives you the principal and interest on that scenario. You also see up at the top here, it does say if the rate is locked, yes or no. So once it becomes yes, then we have to send you an updated disclosure if any of this stuff changed. So loan amount or sales price or something changed during the process. So you'll see this loan estimate, I would say, one at the beginning, maybe one or two more times before closing, and then you'll get a final closing disclosure at the end. So you'll just see this one form maybe a couple times through the process. So we go down here. Is there a prepayment penalty? No. Is there a balloon? No. Talks about what type of projected payments. So most of the time, you're going to see that this is going to be the same payment the entire length of the loan if it's a 30-year fixed, but you might see this last payment be slightly different just based on the way it's amortized. Now, in this scenario as well, this is a 90% loan. So this one does have mortgage insurance for that first 10 years. It can drop off before then. It just can't go past 10 years. So you can see that one drops off after 10 years. So that's one of the differences you see on this one. But you can also see if there's an escrow account that will be added to it. It does say that the tax and insurance are included, which is this $300. Actually, it looks like I put no in the escrow, but a lot of times this will be yes, is the tax and insurance included in the payment. So down here, we'll have the total estimate of the closing costs and the total amount needed to be brought to closing. So the second page is going to break down these numbers a little bit more. So you're going to see, let's make sure it's big enough on the screen there. Okay, yep. You're going to see the loan origination costs, any admin fees, processing, underwriting. These can vary a little bit depending on the company, the type of loan program, those types of things. You're going to see these costs. Now, these costs cannot go up more than 10%, or sorry, these ones actually can't change at all. So in this box, you can't change these at all. The next one, they can have some variances here. This is credit reports and appraisal fees. And then these ones down here are the title company typically, which are ones that you can decide who you want to use for any title company. A lot of times they're going to be using the agents are going to recommend the title company. I have title companies I like to use, but if you have a relationship with a title company, maybe a family member, or you've used a title company in the past, you have every right to be able to choose what title company you want to use. The next box over here is other fees. This will be like recording fees, transfer taxes. In Utah, we don't have transfer taxes. In Nevada, there is. Other states have transfer taxes. So this one, I'm just using a Utah loan estimate. So it might be a little different depending on the state as well. Then you have the homeowner's insurance. So on a purchase, we typically collect that first year premium up front, and then you make 12 payments into the escrow account, and then they renew that policy in 12 months. So you'll see typically the first year is collected up front. Now, if you've already paid for it, we can take that out of there, but most people don't until they actually get ready to buy the home. But every once in a while, you have somebody a little prepaid because it's tied into maybe their cars or other homes they have or something like that. We just have to show proof that it's paid and in force for the first 12 months. Then you're going to have this one right here. This is the prepaid interest. So what I did is I did this kind of right in the middle of the month. So how this would work, let's say we're in the month of August and we close on the 15th of August. So we cover the interest from August 15th to the end of the month. Then the interest accrues for the month of September, and the first payment's due October 1st. So whatever business day you're closing that month, we need to collect the interest to the end of that month. So if you close on the very last day, this number will be zero. If you close on the very first day of the month, you'll have to collect that entire month's worth of interest. But then you don't have a payment until not the next month, the month after. So I hope that makes sense. When you make your mortgage payment this month, you're actually covering the interest of last month. So this loan is designed to kind of get that ball started with how they collect the interest. So it's really not a fee. It's just timing on when you're closing. And that changes every single day. So in this scenario, you can see it's about $75 per day. If you wait till closer to the end of the month, that number goes down. The next one is anything that goes initially into the escrow payment. I really thought I did check the box that there was an escrow account on this, but I guess I missed it. But this is for the extra payments into the escrow account because just like we talked about, if we close in August, your first payment's not due till October 1st, but the insurance and the taxes are still due 12 months from August typically, or whenever the taxes are due. So we use this to make sure that your escrow account is properly funded, that by the time the payments due next year, there's enough in that account to cover it. And usually see an adjustment that first year if it's a new construction or if it changed from owner occupied to primary residences. There's things that can kind of change that first year, but we try to make sure that we're not short. The last thing we want to do is see a big increase where all of a sudden your escrow account jumps up 12 months from now. So we try to make sure that number is started in there correctly, that you don't see a huge change. But a word of advice on new construction, this is where these things can jump a lot because it's usually taxed as a land or just a lot for 2024. And then when 2025 rolls around, now it's a home. So now the tax assessed value can go way up. So you want to be very careful on new construction that your escrow account is set up correctly. And I would say most of the time, the title companies I work with probably overestimate the taxes for that reason, just to make sure you're not short and make sure that you're not going to have some big tax bill or your escrow account's going to shoot way up. Because if you are short, not only will they pay the higher amount, but now they have to add the higher amount plus what you're short to your payment. You could see your payment jump up, even though the rate didn't change, the mortgage didn't change, just that escrow account changed. So, quick tip on new construction: you want to be aware of that escrow account and what they're claiming or what they're calculating as the taxes. If anything, you want to maybe pad that number just a little bit. All right, let's keep going here. This other section could be anything else. Maybe there's a termite cert, maybe a foundation cert, or home warranty, or a broker fee. Sometimes the real estate agents might have some sort of archival fee. So you'll see these kind of in this lump sum here. Anything in here generally doesn't have a cap to it because it's not really part of our profit centers and our disclosure. It's something else that's just part of doing the loan. I would say most common is some sort of broker fee with the agents or some sort of HOA fee. That's what most commonly will go in this box. So then down here, we're going to have the total costs. We're going to have the down payment. We're going to have any deposit, earnest money deposits, any kind of deposits on the build, whatever the deposit might be. And then maybe if there's any kind of seller paid closing costs. So I just kind of put some normal numbers in there. And then this estimates the final short to close if all these numbers here are perfect. But you can see we have appraisal that's padded. We got a credit report that's padded. We have the insurance. We don't have the exact number. The rate's not locked in. So these numbers can change a little bit. Title's pretty close. Usually we try to get pretty close on the title fees. But even then, I'll usually pad them just a little bit to make sure if there's a notary fee or something that pops up, we've got that covered. And we always kind of pad the recording fee, just trying to make sure that this number doesn't go way up without a good reason. And if we miss something, like the other day, I had a client that had a big reinvestment in the HOA. It was $1,000 that the HOA required on every new purchase. That's not something that's on every single file, so we missed that one. But it's something we try to make sure we get this as close and accurate as possible. But if you remember from the beginning of the video, we don't have a lot of time to get this out. So we don't have all the information yet. So as new information comes in, we reissue this form with anything new that pops up. So you just try to keep you in the loop. When we learn something that changes, we want to get that out to you as quickly as possible. So the most common one is when we change it from floating the interest rate to locking it. That's the most common one we'll send out. But a lot of times during that process, we'll have an appraisal report back so we can adjust that. We'll have your insurance back so we can tighten that number up, make sure the title fees are right. So we usually have it a little closer to what you'll see at closing on the next loan estimate. So down here is some additional information about who I am, my license number, state license number. It'll give a comparison after 5 years. It'll give you the annual percentage rate. Right here, the total interest paid as a percentage. Again, these are just disclosures so you can compare this loan estimate with somebody else's. So because anybody can offer you this, but when you have all these factored in, then you have a comparison tool of how much different is the savings really going to be. So this is not your actual interest rate. This is just simply being able to compare apples to apples with other loan programs if they offer the same interest rate, but the fees are different. So it's a way to be able to compare. Here's some other considerations. Talks about an appraisal, talks about whether this loan is assumable, which most loans aren't. There's only a couple that are. Talks about needing homeowners insurance. Big one here talks about your late payment. You have a 15-day grace period. After that, it's typically 5% of the payment. Some loans don't let you do 5, sometimes cap it at 3 and 4%, but it'll tell you based on the type of loan you're getting how much of a late fee there can be after 15 days. Then after 30 days is when it's actually default and it'll report negatively to your credit. So you're fine from the 1st to the 15th. From the 15th to 30th, you have a late fee. From the 30th on or after the calendar month, then that's when it's laid on your credit. And then last one here is servicing. Do we intend to service your loan or transfer the servicing? Now, this can be a hot button issue. Some people really don't like their loan being transferred, but a lot of times it's not just going from it's going within Patriot's system. It's not always just completely getting sold. Sometimes it's going to a servicer within our company, or sometimes that's just who does the servicing on the loan. Like there's Idaho Housing, Utah Housing, some of these different programs, they service that loan. We close it in our name, kind of make sure all this stuff is handled. Then they just take over the servicing. So just kind of how the nature of that loan works. So it just tells you whether or not we intend to keep it in our name or whether it's going to be transferred. And a lot of times it's going to be transferred, whether it's within the company or outside the company. A lot of times it will be transferred. So hope that's clear as mud. A lot of stuff, huh? All right. So we're going to hit yes on that. Next form, acknowledgement of receipt of loan estimate. So even though you did sign it here, this is a whole nother disclosure that says that you did receive a copy of the loan estimate. All right. I got to scroll back up. This one's the actual application. So let's go back up to the top. All right, so let's see. So right here is the Uniform Residential Loan Application, or ERLA is what we call it. And now it has sections instead of pages, and this is going to go through names. So you just want to check spelling, make sure that's right. It typically will have like your phone number, email address. It's going to have social, obviously just fake social, fake date of birth. It'll have whether it's individual credit, your current address. So this is just how all the information you either submitted online or we went over the application on. This is where you would have that information. So it's good just to check it, make sure the spelling's right, dates are right. We can always correct that. So you can still sign this form, then we can correct it in the system. And the next time it goes out or by closing, we'll make sure we have everything exactly the way you want it. A common one is maybe you want a middle initial in your name or the address is spelled out with S or South. I mean, there's always kind of little changes. Maybe dates of employment might be slightly off, like how long you've been employed at a certain employer. Maybe it's the different address. Like sometimes I'll have somebody say I work for Walmart and we don't ask which location and we put down the Washington Walmart and it's actually the Bloomington one or, stuff like that. So it's just good to kind of double check this information is accurate. So just kind of scan through it and let's see if there's anything on here that really jumps out. A lot of it's just going to be where you've lived, where you've worked, other income sources. So if there's anything there that we didn't list, maybe a pension, child support, any of that you want to list. Financial obligations. So we'll have a credit report pull and it'll have the different debts that are here. Any other real estate. So if you own other properties, it'll be here. So you can see there's sections for almost everything. Here's other properties. So if you own more than one property, it'll be listed here. What else we got? Here's the actual specific property we're buying. So this is the actual property details here in section 4. So just double check that looks all right. The declarations page in section 5 talks about this being a primary residence, that you don't own other property, that you haven't had bankruptcies or judgments or foreclosures. So you can see our outstanding judgments, delinquent on federal debt, all the yes and no answers that we go through at the time of the application or when you fill on the website. And then down here is the acknowledgments that just talks about don't use somebody else's social security number, complete the information correct. And then this is where I'll sign here. Whoop. Boy, this thing zips down here, doesn't it? So let's scroll back up to the top. Okay, where did that signature go? Oh, and then right here, this will be where my signature goes as the originator. So that goes all through there. All right, here we go. Homeownership counseling organization list. Again, this is going to show you any companies that are within a certain distance. They try to list as many as we can find within the zip code that of the house that you're buying. So it'll show you the 10 closest based on that zip code. So here's all the counselors you can call and go through. Debt management, counseling services, they're all approved by HUD or some other branch of the government that is approved to be able to handle home buyer certifications. So that goes down there. Usually I have to do at least 10, I believe it is. We can do more, but usually it's 10 right here, 10 closest results based on the zip code. And then you'll sign that one. Right here's loan terms, lock or float. So this talks about right now that we are floating in this case. And when you lock it, you'll get this updated as well. And one quick thing about loan floating and locking, it's just kind of the terms we use in the industry. When you lock a loan or lock an interest rate, you're not locking that specific interest rate. You're locking that day's pricing. So if something changes with the credit, maybe we're able to fix a credit thing, maybe there's a late we're able to fix, or something changes and we can get your scores up, we can go back and adjust it. Or let's say, hey, I'm going to put more money down than I originally thought. We sold our house, got a little bit more money. Whatever reason, we're going to change the loan amount, which changes the interest rate. Again, we go back to the day that we locked and adjust it based on that day. So you're not locking that specific rate, you're locking that day's pricing. So if any new information comes in, good or bad, we have to go back and adjust that interest rate back on that day's pricing. Most interest rates are locked for 30 days. I have seen that are 15 days. I've seen some that are longer if they're construction loans, things like that. But I'd say most common is going to be a 30-day lock. You have that interest rate good, and you have to close, fund, and record the loan within that lock period. So sometimes we do want to get a few days into the file, unless rates are going nuts. We want to kind of get down the road a little bit to make sure that we're getting a complete file before we lock it in. Some loans are locked day one, some wait way too long. It just kind of depends on what's happening within the market. But generally, it's going to be a 30-day lock when you lock an interest rate. So we're going to acknowledge that down here, right here. All right, scroll back to the top of this one, private mortgage insurance disclosure. So in this scenario, I did a 10% down mortgage loan. So there is mortgage insurance. So this just is this disclosure of how that mortgage insurance works, when you can cancel it. All those options are built into that. And that can change based on what mortgage insurance company we end up using, but at least it's a disclosure of how that mortgage insurance works. So we'll sign that one. Let's go back up to the top here. Oh, it might actually be, let's see what happens here. Oh, we just missed a box at the beginning. Okay. So yeah, so that's all signed. So now you can go back through it slower. So now that if you want to kind of sign through it all and then go back through it, you can. Again, this doesn't force you or us to a loan. It just acknowledges that you're getting a copy of some of this stuff up front and designed to be worst case scenario. So you can see there's a whole bunch of stuff. And if this doesn't get electronically signed within a certain period of time, we have to mail all this out to you. So we really do try to get this at least digitally signed. But if you're not tech savvy or don't like doing this stuff, we can walk you through it at my office, walk you through it over the phone. I've done that with many clients. Some people really just fly right through it, but other people do get stuck on it. But it is worth kind of going through it after you get it all finished. So after it's all electronically signed, we're going to hit the finish button here. And then I'll get a notification that this has been electronically signed. So then we are able to, let's see. Oh, let's just log back in there again. All right, let's go back in there. Took too long to sign it, trying to explain everything. Okay. So now that will be completed. So now we can go to any other tasks in the system. You can upload your documents into this portal. It's a secure portal, so it can, if you're savvy enough to be able to handle that, you can. This right here is probably the e-consent again, which is already checked. So we're just back on the home screen here. So right here, you can upload the documents if you'd like. So if you have your pay stubs digitally or W-2s or tax returns, you can upload those right in the file. You can email them to me. Just communicate with me which way you'd like to do that. Or a lot of times clients still come into my office. I make copies, whatever we need to do there. But we try to give our clients as many options. You don't have to use the portal. It's just one other way you can get the information to us. And anything you put in the system is secure this way. So it is nice to be able to use it this way, but not everybody likes to use portals and things like that. You can check the summary right here. This will show you kind of the details of the loan. If anything's changed, it'll change here. Closing date. So you can just kind of double check all the information is right here. And then any notifications that are needed will be right here as well. So you might check that once in a while. We usually send an email if you have to go in there and sign anything. The most common thing is going to be an updated loan estimate or something like that. There's toolkits here you can review that just give you pointers about this whole process and what's happening. But that's the most important thing we need to do right off the bat is get those documents e-signed. So I hope you found this information useful. This is kind of the first step to allow us to order appraisal and kind of get your information in the system. Now, sometimes we already have the documents that are listed here, so you don't have to use the portal again. Like I said, just communicate with me on how the best way to get those documents are, whether it's face-to-face, using the portal, email, or whatever's easier. I'll come out to your house. I mean, there's all kinds of ways we can get the documentation, but the sooner we get that, the sooner we can move on to next steps of actual processing, underwriting, things like that. So I hope you found this information useful. Call me with any questions, comment below, anything you liked about the video, any disclosures you didn't understand, let me know. But I really look forward to working with you on this file, and let me know if there's anything else I can help you with, and we'll get started on your next step after we get the disclosures. Thanks for your time.